Hello, all, and welcome to Chapter 1 Introduction Online Transfer Pricing course. You are listening to CA Gaurav Garg. I am a chartered accountant based out of New Delhi, India, and working in transfer pricing for almost 12 years. So, this time we thought let's do something for the seniors or friends who are interested in understanding this transfer pricing, which is one of the most litigative international tax area. Through this video tutorials, I am hopeful that I would be able to add some value when it comes to transfer pricing. And in case if you have any issues or if you wish to discuss anything on transfer pricing, please feel free to write an email to me, or you can call me on my mobile number in the given time slot. So we have added all of you in our this Google group, and you will receive an email through Google group or through WhatsApp, and the time slots will be given in those email messages or the WhatsApp, and you can call me based on those time slots available. This is the very first chapter, and we're going to talk about introduction. We'll try to create transfer pricing base, or some framework how this transfer pricing works. So a very preliminary chapter. In this first video tutorial, we will going to discuss what is transfer pricing, need for transfer pricing, evolution of transfer pricing, and arm's length principle. What is transfer pricing? You all wish to understand these two words, transfer pricing. And some of you may be wondering that this transfer pricing is new to you. However, I personally believe transfer pricing is not new. And many of you, or most of you, in some way or other, are involved in doing transfer pricing. I understand after attending all the video tutorials, hopefully you would be able to have good understanding about transfer pricing. So the very first word is transfer. What do you mean by transfer? What do you understand by this simple word transfer? In common parlance, transfer means moving from one place to another. It's very simple. Transfer means moving from one place to another. What is pricing? Pricing is an exercise to compute price. So what do you mean by transfer pricing? So transfer pricing is an exercise to compute price when there is a movement of goods or services or intangible from one place to another place. That place could be, or that places could be, two business enterprises, unrelated enterprises, or related enterprises. That is, transfer from one enterprise to another enterprise, and both are unrelated. Transfer from one related enterprise to another related enterprise. Correct? And why I said you guys in one or another way involved in doing transfer pricing. So when you go to market to buy some product, maybe a mobile phone for you yourself, you tend to evaluate what is the price of a particular handset. If you go to shop X, what is the price in shop X? If you go to shop Y, what is the price in shop Y? You try to find out what is the price that you should pay for buying a particular mobile handset. What you are doing in this exercise, you're trying to compute transfer price, or you're trying to arrive a price that you should pay to unrelated party. Similarly, if you are a tax professional, or if you are a CPA or an accountant, when you provide services to your client, you evaluate what price you should charge from your client. Such process could be based on your hourly rate, your prior experiences, based on the market tendency, that what the client is going to pay for this work. But when you do all this, what you are doing? You are doing nothing but transfer pricing. So in my understanding, transfer pricing is a term which talks about mechanism of computing price at the time of transfer. However, when it comes to tax, transfer pricing generally reflects a mechanism to compute price when there is a transaction between associated enterprises or related enterprises. So, transfer pricing refers to the mechanism by which cross-border intra-group transactions are priced. And many countries, they do have domestic transfer pricing also. So they when there is a domestic transfer pricing, so not only cross-border intra-group transactions, rather the domestic transactions are also covered within the ambit of transfer pricing provision. So what is the difference between the transfer pricing which we were talking about in the last slide and which we are talking in this slide? So in the first slide, when we were discussing about the transfer pricing, we were referring to a journal definition of transfer pricing. And in this case, we are referring to transfer pricing for tax. And the difference is, in the first slide, it was not under the law. In the second slide, it is under certain law. That law is your income tax law. And when the transfer pricing is part of a law or a regulation, one needs to follow those law or a regulation to compute transfer price. Whereas when you talk about transfer pricing in general, you are free to adopt your pricing policy or a mechanism to compute price. So when we'll come to the law, when we'll come to the regulation, we need to follow the mechanism given in the regulation for the purpose of transfer pricing. Let's go to the UN manual on transfer pricing, how it defines transfer pricing. It says transfer pricing is the general term for the pricing of cross-border intra-firm transactions between related parties. Transfer pricing, therefore, refers to the setting of prices for transactions between associated enterprises involving the transfer of property or services. So nothing new. We have already discussed this. In another definition, which was used by John Neighbor in its article, he says transfer pricing refers to the allocation of profits for tax and other purposes between parts of a multinational corporate group. So this definition gives us the sense that through transfer pricing we're going to allocate profit between different companies of the same group which are based out of different jurisdictions. So the transfer pricing will going to assist tax authorities in finding what profit should be taxable in country A and what profit should be taxable in country B. Now let's discuss why we need transfer pricing or need for transfer pricing. We'll try to understand need for transfer pricing through a value chain. This is simple value chain which has got, let's say, a research and development function, procurement function, manufacturing function, distribution function, and sales. So there's a simple organization which is involved in doing these 5 functions: R&D, procurement, manufacturing, distribution, and sales. So the profitability of this organization is, let's say, 2000. So sales is 10,000, R&D, the expenditure on R&D is 1000, expenditure on procurement is 3000, expenditure on manufacturing is 2000, expenditure on distribution and sales is 2000. So the profit of this organization is 2000. This is the the profitability statement of, let's say, of an organization. Now this company wishes to set up another organization in country B. So in country A they are doing R&D, procurement, manufacturing is shifted to country B, distribution and sales is in country A. So if you see this, they have shifted the manufacturing function, and now the cost of manufacturing is 1000, whereas earlier it was a bit higher in comparison to country B. So they have transferred the function of manufacturing to country B, and now country B will manufacture the products and supply the same to country A. So the question comes that the transfer that will happen from country B to country A, this should be priced at 1000 or 1500 or 2000 or some XYZ price. So in the transfer pricing we need to find the transfer price of a goods manufactured in country B and getting transferred from country B to country A. So further, let's say the tax rate in country A is 25%, tax rate in country B is 10%. So through this example, if you see, this TP means transfer price adopted by the company. So if the transfer pricing is getting higher, 1000 in the first case, 1500 in the second case, and 2000 in the third case, so from country A to country B, the profits are getting shifted. So when the transfer price is 1000, that is the cost of country B, the effective tax rate which this company paid was 25%, whereas when this transfer price went up to 1500, the effective tax rate came down to 22.5%, and when it went up to 2000, the effective tax rate came down to 20%. So through this transfer of profit, the global companies, they try to reduce their effective tax rate, which in turn increases the shareholders' return. So the tax authorities across the globe, they tend to use this transfer pricing concept or regulations primarily to protect their tax base. So by adoption of transfer pricing regulations, it assists in correct application of separate entity approach and secure tax base in jurisdiction involved. It also assists in treating MNEs and independent enterprises at the same level. So it gives the same, tax treatment to both multinational enterprise and independent enterprise. So when companies, those who are operating globally or global MNEs, through reduction in tax, they tend to become more, I will say, cheaper, or their product cost comes down, their shareholder return goes up. They tend to become more competitive in comparison to enterprises which are not MNEs, or which have not arranged their business in such fashion. So transfer pricing also assists in creating that level playing field. That is the broad purpose of transfer pricing, that is to protect tax base and to have broad parity of tax treatment between MNEs and independent enterprises. My next slide is on evolution of transfer pricing. So we're going to discuss brief history of transfer pricing from where it started and where we stand today. So based on the literature, I understand that somewhere after the First World War, 1917 to 1920, this United Kingdom and United States, they introduced transfer pricing provisions, not specifically, some sort of a regulation or a provision within the Act. So formally in 1928, the section 45 was specifically included in the Internal Revenue Act of United States, which reads as, in any case of two or more traders or businesses, whether or not incorporated, whether or not organized in the United States, and whether or not affiliated, owned or controlled directly or indirectly by the same interest, the Commissioner is authorized to distribute, apportion, or allocate gross income or deductions between or among such traders or businesses if he determines that such distribution, apportionment, or allocation is necessary in order to prevent evasion of taxes or clearly to reflect the income of any of such traders, trades, or businesses. So if you see the last line which I have underlined, you will appreciate that it do talks about some kind of comparison. The income of any of such trades or businesses. So the section 45 specifically brought transfer pricing provision wherein the power was given to the officer, the tax officer, to recompute the taxes, to recompute the profit based on the profits of similar entities. And then, first time we got the word arm's length in the report of M.B. Carroll, which was submitted to the League of Nations in 1933, wherein he observed the methods proposed may be classified under two general headings. One, allocation on the basis of remuneration or for services rendered to the enterprises, and allocation on the basis of presuming a sale between interested establishments at the price which would prevail between independent persons dealing at arm's length. So the word arm's length first came into the existence in 1933 in the tax world. So this suggestion of M.B. Carroll was adopted by League of Nations, and when the draft model treaty came in 1933 and 1935, the mention was there of the arm's length principle that should be used for controlled transactions. And then later on, United States adopted the arm's length standard in 1935, and OECD also adopted arm's length principle in 1963 in its model convention. And then came the detailed regulation on transfer pricing in 1968 in the United States, and in 1979 OECD published first transfer pricing report, that is report of the OECD Committee on Fiscal Affairs on transfer pricing and multinational enterprises, and updated the same in 1984. Until till 2010, we saw further amendment in the OECD guidelines and also the US regulation. And now the world, the transfer pricing world, is evaluating BEPS, that is base erosion and profit shifting. And many countries, they have introduced transfer pricing regulations. So, but the broad principle, whether you are in Singapore, you are in India, or you are in South Africa, or you are in Canada, or you are in Europe, or you are in United States, the broad principle remains the same. That is the arm's length principle. So we'll going to understand what is arm's length principle. So what do you understand by arm's length principle? Why arm's length? What it reflects? Why not we are using a finger length, or a shoulder length, or a leg length? Why arm's length? So if you'll meet someone who you do not know, and when you simply do a shake hand, or when you meet someone for the first time, when you do, you simply going to shake your hand. So you try to maintain the arm's length with unrelated parties. And when you are meeting someone close to you, someone known to you, you generally breaches that distance of arm's length. So that's why the word is there, arm's length. It says, you must maintain that distance. The distance that you maintain with unrelated party, you should also maintain the distance when dealing with related party. That is the basic theme of arm's length. So you should treat both your related and unrelated parties in similar fashion. Now if I go to Article 9 of OECD model convention. It says where conditions are made or imposed between the two enterprises in their commercial or financial relations which differ from those which would be made between independent enterprises, then any profits which would but for those conditions have accrued to one of the enterprises but by reason of those conditions have not so accrued may be included in the profits of that enterprise and taxed accordingly. Let's read it once again. So this line, the conditions are made or imposed between the two enterprises in their commercial or financial relations. They're talking about a controlled transaction in this line. When they say which would be made between enterprises, they are referring to uncontrolled transaction. And when they are using the word differ, they are referring to comparison between controlled transaction and uncontrolled transaction. So controlled transaction needs to be compared with uncontrolled transaction. And if there is any difference, one will adopt uncontrolled transaction to compute the price or incomes in the controlled transaction. So thus, under arm's length principle for tax purpose, actual term including price are replaced with arm's length terms including price and taxable profit is recalculated. So it is basically deriving price for controlled transactions. So if we wish to derive a price, we need to find a comparable transaction. So we need to follow the law of comparison, which talks about that everything should be normal. You cannot compare normal circumstance with abnormal circumstance. So under arm's length principle, we need to identify a comparable transaction in a normal circumstance, and then we need to derive a price for a controlled transaction. It is to be noted that global formulary apportionment approach, which is alternative to the arm's length principle, is not an accepted standard. So often you will find a debate, that global formally apportionment approach is better than the arm's length approach. But OECD and UN, both of them, they have adopted arm's length principle over global formulary apportionment. For the sake of interest, global formulary apportionment is something wherein you allocate the global profit, losses on an M&A group on a consolidated basis among the associated enterprises in different countries on the basis of predetermined and mechanistic formula. That is, let's say if the total profit of the group is 1000, you tend to divide this 1000 in different jurisdictions based on some formula. That formula could be, let's say, we are going to use sales as the base to divide the profit, or we are going to use the cost as the base to divide the profit. So if the group is into the loss, you will going to allocate loss to all the locations, and if group is into the profit, you are going to allocate that profit to all the locations. However, under the arm's length principle, irrespective of that group is into the profit or a loss, an entity may have profit or losses. So when I am dealing with independent party, what is the profit of that independent party is not important. I will charge my price. So if my price is, let's say, X rupees per hour, I will charge X rupees per hour. Whether that company is into substantial profit or deep losses, that is something not very important to me. I will not say if you are into losses, I will also be into losses. If you are into profit, I should be in profit. So that's why the global formulary apportionment approach is not the accepted standard. So what we're going to discuss is the arm's length principle. So in case if you have any question on this basic slide or this basic tutorial, that is the chapter 1, feel free to write a query to me on my email ID, which is gaurav@jgarg.com, or feel free to drop me a WhatsApp on my WhatsApp number, which is +91, that is the country code, and then 9899994934. Through this first chapter, I think I am able to generate some basic concept of transfer pricing. As we will move forward, we're going to have more discussion on transfer pricing, various methods, documentation, intra-group services, royalty, intangibles. And in case if you wish me to discuss something particularly, you can always suggest me on an email ID. I will try to cover that if possible in future slides. If you have any suggestions for me, do share your suggestions, because this what we are doing free first time. I have spoken on transfer pricing many a times, but conducting online transfer pricing course is something new to me. So feel free to share your suggestions. Thank you. I'm waiting for your feedback.